Financial ratios analysis tells the story behind the numbers on financial statements. It helps to judge creditworthiness, valuing equity shares, assessing market risks, in short, health and stability of the business. Financial ratios enables to compare two companies irrespective of the size of the companies. Let's understand this with real-time examples of two companies. NVIDIA Corporation, Advanced Micro Devices, Inc. AMD. Profitability ratios linked to profit and loss statement or income statement. Liquidity ratio and leverage ratios are linked to balance sheet statement. Management effectiveness ratios are linked to both profit and loss statement and balance sheet statement. Let's understand them one by one. Gross profit indicates the company's profitability and calculated as difference between revenue and cost of goods sold. Gross profit margin ratio is the gross profit as a percentage of revenue. Operating margin is earning left after deducting cost of goods sold and operating expenses. It is a measure of margin left for shareholders as a percentage of net sales. Return on sales measure how efficiently the firm can convert the sales into profit. Useful only when comparing companies within same industry or with similar revenue. Current ratio is a liquidity ratio that measures short-term ability of firm to meet current obligations during the operating cycle. Debt-to-equity ratio or leverage ratio assesses the ability of a company to meet its financial obligations. It is important because companies rely on a mixture of equity and debt to finance the operations. Return on equity is the measure of profitability in terms of the equity. As equity is net position of assets and liabilities, return on equity also considered as return on net assets. It represents how effectively management is using a company's assets to create value. Asset turnover is the ratio of revenue to average assets. This represents how effectively firm is using assets to generate sales. Return on assets, ROA, also can be calculated to evaluated efficiency of the assets. The main difference is that the return on assets, ROA, considers net income and asset turnover considers revenues. It factors in a company's expenses as well. Inventory turnover indicates how fast a firm sells inventory in a given period. Receivable turnover measures how effectively firm manage the receivable from customers. Receivable turnover also can be calculated as days sales outstanding. It indicates how fast firm can collect the outstanding accounts receivable invoices over a specific period of time. If DSO number exceeds the specified norms, the collection is considered to be slow. Hope this video will help you to calculate the financial ratios and what meaningful information it provides.